Determining a company's share price is a fundamental aspect of investment analysis and corporate valuation. There are several methods to calculate or estimate the share price, each based on different assumptions and data inputs. The most common approaches include the income approach, market approach, and asset-based approach. The income approach for determining share price is a method used to value a company's stock based on its future income or cash flow generation. This approach involves forecasting the company's future cash flows, discounting them to the present value, and then determining the value per share. One of the most common methods within the income approach is the discounted cash flow (DCF) analysis. The free cash flow, FCF, is calculated by subtracting operating expenses, taxes, and necessary capital expenditures from the company's total revenue. The discount rate reflects the riskiness of the future cash flows. A common discount rate is the weighted average cost of capital, WACC, which represents the company's cost of debt and equity. Discount the projected FCFs back to the present using the discount rate to account for the time value of money. To calculate the present value, PV, of cash flows, use the formula PV equals FCF, 1 plus RT, where FCF is the future cash flow in a given year, R is the discount rate, WACC, and T is the number of years into the future. After forecasting FCFs for a set period, calculate the terminal value, TV, to account for the company's value beyond the forecasted years. A common way to calculate the terminal value is using the Gordon growth model.
The terminal value, TV, is calculated using the formula TV equals FCF underscore last times 1 plus G, R, G, where FCF underscore last is the final year of free cash flow in the forecast, G is the long-term growth rate, and R is the discount rate.
Sum the present value of cash flows and terminal value to get the enterprise value, EV. The enterprise value, EV, is the sum of the present values of forecasted FCFs and the present value of the terminal value. To calculate the equity value, subtract the company's net debt, total debt minus cash, from the enterprise value. To get the share price, divide the equity value by the total number of shares outstanding. The market approach for determining share price is based on comparing the company being valued to similar companies or transactions in the market. There are two main methods within the market approach: comparable companies analysis, comps, and precedent transactions analysis. Both methods use valuation multiples, such as the price to earnings, PE, ratio, enterprise value to EBITDA, EV/EBITDA, or price to sales, PS, ratio, to determine the value of a company's shares. Steps in comparable companies analysis include selecting comparable companies, choosing relevant valuation multiples, calculating the valuation multiples for comparable companies, applying the average multiple to the target company, and calculating the share price. Select a group of publicly traded companies in the same industry or sector as the company being valued. The company should have similar characteristics, such as size, growth rate, and business model. Choose relevant valuation multiples like PE ratio, EV/EBITDA, and PS ratio.